Liquidation doesn't mean you have to lose everything, but if you don't act now and get educated, your business debt could cost you your home, your savings, and your peace of mind. Please, this is a wake-up call for you all. Every day, directors across the UK are facing sleepless nights. They're wondering if a liquidation will leave them personally liable for business debts, ruin their reputation, or destroy their chance to rebuild. Now, if you ignore the problem of business debt, or you try and cut corners, I don't know, like dissolving a company with debts or mishandling assets, you could face legal action, lose your personal wealth, or even risk being banned from being a director. Now, I want to tell you a little bit about me, a little bit about my story. Obviously, my name's Chris Worden, I'm from Director First, but I have been where you're at. About 10 years ago now, I was staring insolvency in the face. My business had pretty much overnight collapsed, and I really did not know where to turn. I'm out there searching the internet, calling these insolvency companies, and after every call or every website I watched, I was more confused than when I started, and everybody seemed to give me slightly different advice. I realised there was no one out there specifically to advise a director. And over a good number of years now, that's what my business is here to do. It's here for you, to give you advice and help you avoid pitfalls. Now, in this video, I'm going to break down exactly what liquidation means, the different types of liquidation, how long they take, what they cost. And plus, I'm going to tackle some of the biggest worries directors face and show you why liquidation is often the smartest way forward. So stay with me to the end, because this information, it could save your future. I mean, let's start with liquidation. What does it actually mean? Well, the term liquidation, it's the process of formally closing down a limited company, and if it has any cash or any assets in the business, converting those assets into cash to pay off some of its debts, or all of its debts in certain scenarios. And if there's enough left after paying off all of the debts, some of the remaining funds can be distributed to shareholders. Now, these are two different types of liquidation that I'm talking about. Now, once the process is complete, the company gets dissolved and it ceases to exist. Now, key points I want to talk to you is, first of all, the aim of a liquidation is to repay creditors in order of priority, okay? Lots of you who are watching this and you liquidate a business, you might have very little assets or no assets at all. If that's the case, there is no assets to be realised and there is no return to creditors or shareholders. But the process of a liquidation has to be managed by a licensed insolvency practitioner. They're sometimes called liquidators. Now, the first question that you want to ask yourself really are, am I insolvent? Is my limited company insolvent? And there's a thing called the corporate insolvency test. And if you go through these questions, it will tell you whether your business is insolvent or not. And the first test is the cash flow test. And dead simply, it's, can your business afford to pay its debts on time? And if it can't, it's an indicator that it's insolvent. So if you're in a time to pay arrangement with HMRC, that is an indicator that your business is insolvent. The second test in the corporate insolvency test is the balance sheet test. And that question is, does your liabilities exceed your assets? So if you total up everything that you owe and compare it to all the assets that the business owns, if the liabilities are more than the assets, you're also insolvent on a balance sheet basis. Third test in the insolvency test is the legal action test. If one of your creditors has got a CCJ against you, or worse, the statutory demand or a winding up petition, that is a clear sign that your business is insolvent also. So if your business is insolvent, the liquidation that you're probably going to be considering is something called the Creditors Voluntary Liquidation. CVL for short. Some people call it a bog standard liquidation. Now, it's initiated by directors of companies when their company becomes insolvent. And there's a number of steps involved, right? First of all, you've got to find an insolvency practitioner. So you do that by looking at a handsome chap with specs on YouTube, or you might be searching the internet for Close My Company, insolvency practitioner. The key thing here is do your due diligence on whoever you're talking to, including me. Perhaps get more than one opinion and tell them about everything that's going on. Explain to them your worries, your concerns. Now, at that stage, you should be getting a written proposal from that insolvency practitioner, okay? If you're not getting a proposal, if you're not getting everything down in writing, you need to pause and you need to ask them to send you an email outlining everything. Obviously, when you're looking for insolvency practitioners, before you put pen to paper, check reviews, check their internet footprint. Do you know people who have used them before? Because not in every insolvency practitioner is the same. Like in any industry, you've got some very good ones and some that aren't so good. You'll find all this out if you do your due diligence. It's a big decision, okay? But once you've made your mind up, you've got a proposal, you've checked the reviews, you're going to be asked for a raft of information. They're going to send you a shopping list of what they need. And there'll be stuff like ID, proof of address, a list of all your debts. They're going to want to know about employees. They're going to want to know if there's any assets in the business. There's a whole raft of info you're going to have to give them. But once you've given them, you're going to be given something called your liquidation notices. You sign your liquidation notices and you send them back to the liquidator. They will then circulate them to the creditors of the company and they will propose something called a creditors meeting. And that is exactly what it says on the tin. It is a meeting where the creditors can ask you questions about the company failure. I've been doing this a long, long time. I've been involved with thousands of liquidations over the years. And the actual amount of creditors that turn up to a creditors meeting is very low. Especially if, let's say you owe HMRC, you owe a bounce back loan or a C-bills or something. The chances of anyone turning up to that creditors meeting, in my opinion, is very low. And if no one turns up to your creditors meeting, it's done very, very quickly and it's over in minutes. And that is where the insolvency practitioner you have chosen becomes appointed as the liquidator. They will make staff redundant. Their job is to liaise with creditors. So hopefully it'll take a bit of pressure off. If there's any assets, it'll be their job to sell assets. They're obviously going to investigate the director's conduct, right? And this is where you can get more fees building up because you're going to ask them what does it cost to liquidate, and it's going to be 4, 5, 6, 7 grand for a liquidation, and you think that's everything. But they're going to investigate things like, have you got an overdrawn director's loan account? This is dead important. If you owe the company money, you're going to be asked to pay that money back by the liquidator once they become appointed. Now, a good firm like us will help you understand this before you decide to do anything, okay? But some firms don't mention it, and it's going to be something that's going to really bite you on the backside down the line. Now, the first place to start is, have I got an overdrawn loan account? So where will you find that? You'll find it on your last set of accounts in the assets section. It might be under debtors, people that owe the company money, or there might be a section that says directors' advances. Now, the problem with checking your last set of accounts is your accounts are generally in the past. What you're better off doing is having a look at some management accounts, and you'll get them from Xero, QuickBooks or Sage. The issue there is, though, if you're using this accounting software, that's good. But if you don't update the accounting software, you can't trust what numbers it spits out. But before you hit the button on an insolvency, you've got to understand your director's loan position. And if you owe the company money, you need to have that conversation about, can you afford to pay it back? Most directors can't afford to pay it back. I've got a new mic now. Most of directors can't afford to pay it back. So in them scenarios, a settlement will be done. But if you're a director that has a lot of equity in your personal house, you have buy-to-lets, you have quite a lot of personal wealth, this could really cause you a problem, because in your scenario, it's highly likely the insolvency practitioner can't justify giving you a big discount. Listen, if you're worried about overdrawn directors' loan accounts, pick the phone up, okay? Another area where there's going to be potentially more fees to you as a director is if you've made preference payments. And the easiest way to explain those is, once a company becomes insolvent, your responsibilities as a director change, and you're not going to work anymore to raise money for shareholders and directors like yourself. You can't make creditors' positions any worse. Now, let's say you've got 20 grand in the account and you owe your mum 15 grand, or you owe a supplier that you're on good terms with 15 grand, and you decide to pay that person the 15 grand back in preference of all your other creditors. That is where an insolvency practitioner could actually go, excuse me, Mr. Bloggs, you've just paid your mum 15 grand back when it should have been split evenly. We're going to come to you for another 15 grand. Again, a good insolvency firm will help you navigate these issues like preference payments and advise you on them without asking for any money, okay? Another thing that's going to get your collar felt and cause more fees is something called a transaction under value. And that's essentially when you become insolvent, you can sell the assets of your business to anyone you want, including you, as long as you sell them for market value. Okay, so let's say you've got a vehicle, it's worth 15 grand on WeBuyAnyVan.com, and you sell that vehicle for 5 grand to your new company, and you do the valuation on the back of a fag packet. That is going to constitute a transaction under value. An insolvency practitioner is going to review it, they're going to see it, and they're going to come to you personally or the company you've sold that vehicle for under value for the difference, right? When you're selling assets, you really need to get an independent valuation done of somebody credible, a credible insolvency agent who can give you a report. If you're going to sell assets, you've got to be careful that you're not criticised for selling them after the fact, okay? Listen, when all of this is done, the insolvency practitioner, as part of the liquidation, is going to do a report to the insolvency service, okay? It's not an insolvency practitioner that gets you disqualified, it's the insolvency service. And they'll decide whether to disqualify you or not based on the director's conduct report that they put into them. Again, I've been doing this a long, long time. You know, disqualifications are fairly rare. You have to have done something really stupid to get disqualified, okay? They'll also report to creditors. Generally at months 3, 6, 9 and 12, they'll report to creditors to tell them what's going on. Now, if an insolvency practitioner finds that you've been at it, you've been doing stuff you shouldn't, doing stuff you've not told them about, there's a good chance they'll take legal action against you. So it's dead important to get everything out on the table up front. And when all of this is done, the company is dissolved. It ceases to exist. It disappears off company's house. Okay, that is a creditor's voluntary liquidation. Now, if your business is insolvent, just a reminder, can't pay your debts when they fall due, liabilities are more than their assets. Another liquidation that might happen to you is something called a compulsory liquidation. Stay away from this if you can, okay? Because a compulsory liquidation is initiated by your creditors, okay? It's by a court order, generally HMRC. Now, if you have not paid a creditor and you're not responding to phone calls, you're not responding to emails, eventually they're going to start legal action. And again, HMRC are the biggest one for this. And what they'll do is they will essentially put a winding up petition into court. There will be a court hearing, and then there is an appointment of a liquidator, right? So a creditor serves a winding up petition. You've got a few weeks before the winding up petition is actually advertised. Then your bank account is frozen, and then you get a court date. The court, if you don't pay the amount disputed, or you come to an acceptable form of repayment, the court winds the company up and it gets passed to the official receiver. And the official receiver will investigate this thoroughly. In my experience, a compulsory liquidation will always result in worse consequences for a director. Because the first thing that they're going to throw at you, and it's hard to defend, is you've not behaved appropriately as a director. You've obviously been insolvent. You've been insolvent for some time. You could have initiated a voluntary liquidation as per your fiduciary duties, but no, you've buried your head in the sand and you've been wound up by the courts. Now, let's say that your business can afford to pay all its debts. Not only can it afford to pay all its debts, but once it's paid all its debts, you've got, say, over 30 grand cash at the bank, or you've got assets worth more than 30 grand. You might want to consider something called a members' voluntary liquidation, a solvent liquidation. Now, it's for solvent companies. Now, it's often used because it's tax efficient, right? Basically, you'll pay everybody off, you'll still need an insolvency practitioner, and then at the end of it, you'll be able to distribute the funds to the shareholders. Now, the tax benefits of this is you can access, it used to be called entrepreneurs relief. Now it's called business asset disposal relief. Correct me if I've muddled that up. But it essentially allows you to draw money out of the company at 10%, okay? Now, one question you're probably asking is, how long does all of this take? Well, these are just general timelines, right? And they're different for each process, but a creditor's voluntary liquidation, you can be in liquidation generally 21 days. It can happen sooner, but a rule of thumb is 21 days. Now, once you're in liquidation, it can take up to 12 months to go from liquidation to dissolution. If it's a mega complex liquidation, it can go on for years, but most liquidations will be finalised in 12 months. Now, while an insolvency practitioner is doing their liquidating, so to speak, I don't want you to worry that yours is taking 12 months. It's not that they're spending 12 months looking at you, it's just part of the process, and they'll probably have a raft of liquidations to get through. Now, a member's voluntary liquidation, remember a solvent liquidation, is a lot faster, okay? So let's imagine it's a straightforward cash distribution. All that means is you've paid off all your debts and you've got a lump of money in the bank to distribute to shareholders, right? You can have it in liquidation in sort of 10 to 12 days and close within 6 to 8 months, okay? Again, more complex cases take longer. I'm just giving you a general rule of thumb. Compulsory liquidations, right? They take a lot longer. I mean, some people will get wound up in a few months. Sometimes it will take a year or so to get wound up. And it's slow due to court involvement, okay? And again, the investigation of the official receiver, they can take absolute years depending on the complexity of the cases, okay? Now, one question I am sure is on your lips with liquidation is, how much do these liquidations cost? So again, these are just typical costs for different types of liquidation. A member's voluntary liquidation, you'll be looking at sort of 2.5 to 5 grand, depending on, again, how simple the case is. Creditors' voluntary liquidation, what we're seeing at the moment is actually 5 grand to 8 grand. And again, it varies on the complexity of the job. If you've got an handful of creditors, no redundancies to make, no assets to realise, you're probably going to be billed 5 grand. If you've got hundreds of creditors, you've got, 100 staff, loads of assets to dispose of, that could run into £10,000–15,000. Again, each case is a little bit different. Now, a compulsory liquidation actually doesn't cost you anything because the initial costs are borne by the petitioning creditor, the person you owe the money to. But in my experience, in the long term, it will cost you more money. The penalties are likely to be heavier with the official receiver. And it's not just time cost, it'll rob you peace of mind. And that sort of runs on to one of my other points is the main worries that directors have with liquidations. Well, the first one is personal liability. And I've sort of touched on things where you'll have issues with personal liability. One thing I've not mentioned though, let me have a quick drink. One thing I've not mentioned is bounce back loan fraud. Like if you've misused your bounce back loan, let's say you've took one and you weren't entitled to it, or you've inflated your turnover. You know, for everyone who don't know, you was allowed to apply for a bounce back loan if you was trading in 2020, okay? And you was allowed to apply for 25% of your turnover in 2019. You could not estimate your turnover if you was incorporated before 2019. Only if you was incorporated in 2019 could you estimate your turnover. And you could estimate 25% of your turnover capped at 50,000. If you've lied about your turnover to get more of a bounce back loan, that could cause you personal liability, okay? Another thing that causes personal liability in liquidations is overdrawn loan accounts. And that is when a director owes the company money. I've talked about it earlier in the video, but I'm going to go into it again because it's such an important point. An overdrawn loan account is where you owe the company money, okay? So it's an asset of the company. A liquidator or an insolvency practitioner gets appointed and it's their job to try and get that money back off you, the director. Listen, if you haven't got a pot to you-know-what in or a window to throw it out of and you're in rented accommodation, it's not really a problem. But if you can afford to pay something back, you will pay something back. And if you've got a big house with very little mortgage, this could cause you a huge problem. It's dead important that you speak to someone like me about how you're going to deal with it. Now, another worry people have is the impact on credit ratings. Now, a liquidation is not going to impact your personal credit score at all. Okay, it will not show on Experian, it will not show on Equifax, it will not show on ClearScore, okay? There are certain scenarios where a liquidation may affect your personal credibility. And that is, let's say you've signed a personal guarantee, okay? Now, if you've signed a personal guarantee, it could be with a loan, it could be with a credit card, it could be with an overdraft, it could be with a supplier, and you go into liquidation, the personal guarantee is going to come to you and go, right, I want the money back. Now, as long as you speak to them, okay, and you do some type of deal with them, and it's generally restructuring that personal guarantee over a longer period of time, some people will accept full and final settlements, it will not impact your credit score. I'll share something about my past with you. So I told you I had to liquidate a business in 2014, right? So we had a 25 grand overdraft with a high street bank that were personally guaranteed, joint and several. And why joint and several is important, because I didn't have a bloody clue what that meant at the start. We liquidated, okay, I mean, I'm laughing about it now, I wasn't at the time. And the bank has basically wrote to me and my co-director, and at the time we wanted to throttle each other, right? We properly fell out, best mates. Thankfully, we're best mates again, but at that time, we were gunning for each other. Now, he's obviously been better advised than the insolvency guru, Chris Worden, and he's gone to the bank and he said, listen, I'm willing to give you 2.5 grand, my mother-in-law will lend it me, take it or leave it. And they've accepted it and then come to me for the other 22.5 grand. It never ever went on my credit score, because what I did is I rang the bank and I did a deal with them. And at the start, I was paying peanuts a month. I was just paying it was the easier thing to sort out. The banks are generally super, super easy to deal with, okay? So I hope that has made sense. Now, let's sort of talk about the stigma of liquidation, right? Obviously, a lot of directors, me included, I was worried about sort of the emotional and reputational concerns, right? Now, at the time, I live in a little town in the northwest of England. I'm thinking everybody's talking about me, right? And maybe the odd person was. But now, many, many years on, it's just something that happened in the past. I did the right things at the right time, and you know, lots of business owners, they have to go through this. Now, if you're going through this in 2025, I want to give you a bit of comfort. The last 5 years have been an absolute bloodbath for businesses. Insolvency figures are higher than they've ever been. I think they're higher now than they were in 2012, and 2012 was where like the avalanche of the financial crash actually started collapsing into insolvencies. So please look after yourself, look after your mental health, right? It's not as bad as you think. Now, I want really to tell you from a personal point of view, like you can recover from this. I promise you. The key thing is acting early. Like, seek professional advice. If I've said anything that resonates with you, pick the bloody phone up to me. I offer free and independent advice. Genuinely, it's like a liquidation, if you're insolvent, can be the start of a fresh chapter. Now, please, if you've liked what I've put up today, go and watch my next video about company closure. It's brilliant. It'll really help you. If you like what you watch, view, give us a comment. I'll respond to it personally. And subscribe to the channel. Chris Worden, Director First. God bless you.